As I mentioned a few minutes ago, this is a first for us, and I think these guys are going to be sort of the cheat sheet, if you will, of the day in terms of AdTech, e-commerce, and mobile. And while they're going to get set up, I did my little cliff notes here, but you know, the deal market was nice enough to have a deal in each one of these sectors yesterday. As I'm sure you guys saw, Turn raised $80 million, ideally got sold to Groupon for $43 million, I think it was, and the Nest transaction to Google for $3.1 or $3.4 billion. So since Steve is ready to go, I'm going to ask his view while we're getting the other guys set up. What did you think of the Ideally deal?
So I would say in general, you know, the flash space, born in sort of 2008, 2009, back 3 or 4 years ago, we kept a chart in our office that tracked all the various flash sale players that had a business model similar to us, and there was over 100 logos on that slide at the time. I think what we've seen over the last 12 to 24 months is there's been a small handful of winners, generally the early movers, and I think that generally speaking, others have either gone away or consolidated, and I think that Ideally never had a breakout moment, even though that they were first, and I think that they found themselves a home in Groupon, and you know they weren't much on our radar prior to that.
Yeah. Do you think that's a good home in terms of? I mean, does the fact that Groupon was the buyer there, does that sort of change any thinking from your perspective?
You know, Ideally has always been much more of a mass play. We've always been much higher luxury. I think it probably makes sense for Groupon. Groupon Goods has clearly been a giant growth driver for that business. And one they're passionate to pursue. I think they have themselves, you know, expanded their buying team probably by a decent percentage with the Ideally acquisition, and I suspect it'll be nicely accretive to them.
Good, good. Okay, so Brian, how about you know, there was a lot of talk in terms of IPOs, right? In terms of who went public this year. What do we think about Turn in terms of their $80 million financing yesterday?
I think AdTech is in an incredible bubble. It's a great time to be running an AdTech company if you like money. I think we're going to see a lot of financings. I think while we're sitting here, we'll see another financing, maybe a small acquisition. We'll see another company go bankrupt. We've got a big cliff, an overhang of companies that need to go public, get bought, buy someone. It's just going to be crazy. So it's a great year for bankers in AdTech, actually.
Good. Gotta love it, right? Gotta love it. Gotta love it. Okay, so we're going to come back to talk more about that. George.
Yes, Linda.
Google. Apple. Should have bought it. What'd you think? Nest.
Crazy price. Crazy. God bless them.
Will it be right in the long run?
People miss the scale. They're dabbling in these things. This is not a big deal one way or another. You know, I mean, makes lots of people happy. A lot of venture guys do well. But, you know, at the end of the day, this is not a big crimp into cash flow. This is not, you know, I have no idea what the financials of Nest look like. It's a private company. I have no idea if it's spitting off money. Who knows? I have Nests in my new home, and I like them.
So the good news is one of our predictions for 2014 was that there will be at least $5 billion plus exits. So now we're one down with 4 to go from my perspective.
Ahead. Yeah. But I do echo something that Brian said. I mean, you see it spilling out into mobile too, which is there's this crazy bifurcation in the market of lots of mediocre companies getting funded, and that creates confusion, difficulty for customers and consumers to understand the difference between these things. At the same time, there are some breakout companies that are really going to build sustainable value. And I think you also have companies getting public that really in the long term aren't standalone public companies, but are passing through the gateway of being public to get acquired by something else. And you know, again, maybe good for bankers, but it's really difficult to navigate through all that, I think, right now. I agree it's bubblish, but I also think it's just very difficult to navigate.
Yeah, yeah. I think it's hard.
Yeah.
I would say I think it's hard. So what we're going to do this morning is we're going to do a few sort of general questions, and then I'm going to grill each one of these guys a little bit in terms of specific sectors. And if anybody wants to jump in at any point in time in terms of asking questions, feel free. Again, this is supposed to be the guys your guide to the day in terms of stuff. So let's just talk quickly. Start off with like a softball question of, you know, kind of what were the key themes for 2013, both from an industry perspective and then from your own perspective in terms of you know, what are the things that were sort of on your mind. So
Sure. So I'll start with an industry perspective. It was like the tale of two stories in 2013. On the one hand, you had Zulily with just an amazing IPO and really a demonstration that the flash sale concept has tremendous potential, that consumers are still resonating. I think there was sort of a black cloud that probably Groupon and Living Social gave the space overall, which was somewhat unwarranted over the last few years. And then the flip side of that is I think I saw Fab with some financing in April, and then tremendous challenges maybe 1 week later. And so blaming it all on the flash space. So you kind of had the biggest success in the flash space and maybe the biggest bust that the flash space has seen all in the course of 2013. As it relates to our business, and one of the themes that was up here, the leverage of data to drive value and growth in our business the potential is like I've never seen before. Flash businesses are unique in that we authenticate 100% of our users before they engage with us. So the amount of data we have on all of our customers is just incredible. But the ways in which we're able to complement that data, to leverage the Facebook social graph and all these ways that they're incrementalizing that, to leverage other external data sources to complement what we have and to figure out how to target our customers more effectively, is the potential is amazing. Navigating the way to tap into that potential is really challenging, and one that we've had to more lean on our in-house direction to try to make happen, because we just don't have solutions in the space that can help to pull it all together for us.
So in terms of the data question, do you see yourselves, again, being more internally focused as opposed to, thinking about external sources or external vendors to help you with that?
So it's a combination, but we need to hold the keys to that kingdom and to figure out the way to supplement with third parties that can help to deliver the promise of all that potential. We sort of think about our data opportunities in three areas. The first is the customers we have, the members that we have, if you will. How do we create more loyalty with those members? How do we advertise to those members more effectively? So it might be about personalizing an email, it might be about personalizing a site, or it might be about figuring out a retargeting campaign. The second area is how do we acquire lookalikes or members exactly like them? So how do we take the profiles of our most valuable customers? How do we get the biggest, broadest view of what they do online, not just what they do on our site, and how do we target more of them? And in that world, we need a lot of access to external data, whether it's be a Facebook social graph or other audience aggregation intel that we can supplement with our own. And then the third is to leverage both our internal data and external trends to optimize pricing. And so the nature of our business, new sales start every day. A huge percentage of our product sells out very quickly, often in the first 15 to 30 minutes. How do we understand better supply and demand prior to launching that external pricing out on the web, how it affects us, and how do we actually grow our margins significantly?
That's good. That's good. So Brian, what do we got in AdTech world for 2013? RTB, obviously.
I don't know. Actually, I think that's part of the challenge. I'd love an audience poll. How many people here think they really know what RTB is? It's pretty poor. I don't think you're alone. Of our client base, I think, even our employee base, I think there's still deep confusion about what the difference between an ad network, an ad exchange, a marketplace, an RTB, a BTR, a click-through rate. All this stuff is just jargon that I think in 2013, some companies were able to convince the public markets and investors that they had figured out some magic way to spin straw into gold. And the bottom line is the companies that went public, in my mind, are not even ad tech companies. They're ad networks. They're media companies that use technology as a way to create value, or in many cases, to tell a story about the value they create. Let me tell you how ad tech works, quote unquote ad tech. You walk into an agency, you can correct me if I'm wrong, you walk into an agency, you say, give me some money, and you bring jeans or sunglasses or something like that. That's tech, okay? And you walk in and they give you money, and if you get reasonably good results, doesn't have to be great, just has to be not too bad, they might give you more money. And you can do things like marketing and make it sound like you're doing fancy things, but the entire quote unquote ad tech business is run by a bunch of salespeople who walk into agencies and get money from relatively young, inexperienced media buyers. And that business is a $20 billion business in the US. Google has about $5 billion of that. It's a fantastic business. If you can't run that business profitably, and if you can't go and actually make these media buys work, you're out of business. And if you can, then you're very successful. What I'm missing, I think, is the part where technology really drives and enables that. I'm not saying there's not tech. So for me, last year was the year where everyone got really excited about the wrong thing. They got excited about quote-unquote tech. And they should have gotten excited about was all these high-scale media businesses that now have access to every impression on the planet. That's what the exchange or RT really is the fact that I can right now, from my phone, go buy an impression from any website in the world and almost any mobile app in the world. And that is really exciting. That means if I'm a media buyer, or if I'm a network or an exchange, or whatever you're going to call yourself, there's now an open market, much like the stock market, where I don't have to think about, who do I call to buy a share of Apple? I can call any broker. Anybody can get me Apple. And marketing is now that way. But that should not drive the kind of craziness that we saw in this space in 2013. So I've decided to coin a new term for all of you today. Appnexus is now the AdTech tech company. So we provide technology. So when you start your ad tech business, that you can now say, hey, we have great technology. We'll just be the tech behind your ad tech. And someday someone will be, I think Microsoft or, some of the server companies could be ad tech. We could keep going down the ad tech meta levels. But for me, 2013 was the year when everyone got so excited about something that no one understands. And that's why I think it's a bubble. And this year is the year where a lot of these companies are going to hit a wall, where, much like Fab, where the growth was incredible until it wasn't. And no one really understood that business, at least I sure didn't, well enough to tell you when that wall was going to come. And I think a lot of these quote-unquote ad tech companies are going to have the same problem. Some of these are long-term sustainable businesses that really make a lot of sense and add real value to marketers. Other companies are just really good at executing and have had a really good run. They've found a little vein of gold and they're mining it, and it's going to run out. And we just don't know when. And I think that, to me, is why ad tech is so scary and dangerous, especially from an investor perspective, but also from an industry perspective. If you're a big major strategic company like a Publicis or an Omnicom or a WPP, and you want to make a bet on a technology partner that will still be around and independent and innovating in 2 or 3 years, who do you choose? Those eye charts that the bankers put together scare the crap out of you. And so you have a flight to quality, which plays into Google's hands. To some extent, it plays into other people's hands. But to me, that's what 2013 was. And I think 2014 is more of the same, just amped up because of all the public companies that are doing well and all the IPOs and hype that we're going to see. My job at Appnexus has been to try to keep my team focused on a strategic plan where we build technology that adds value for our customers and ignore all of the hype. It is so hard in New York right now. My employees are getting phone calls, and companies like Google and AOL offer them double their salary to leave Appnexus. We have employees who've been employed with us for 5 months who are bottom quartile employees who get their salaries doubled just because they worked at Appnexus for a little while. And in that market, you can imagine how difficult it is for anybody to create real sustainable value, to keep a clear head. And I think this is why 2014 will be incredibly disruptive in a bad way for many of the companies, at least in my space, because they're going to get excited by the money, they're going to get excited by some big strategic M&A acquisition opportunity, and all of a sudden, they're going to wake up in 2015, and we're going to see this new thing called mobile, which most of these companies have no idea how to prepare for or operate in. So if you want to be a contrarian this year, watch out for who's actually making real traction in the 2015 market towards mobile, towards some of these e-commerce trends that we're seeing. Who's actually delivering value for Steve? Who do you call when you need to find new users to retain your team? And if it's not a clear story, then it's going to be really ugly next year. So for me, that's a lot of what I'm seeing, at least in the quote-unquote ad tech market right now.
So that's there's a handful there. We got to stop and ask a few questions. One is starting with your simple explanation in terms of, okay, well, if it's the guy goes in and he talks to the media planner and he says, give me some money. So why isn't there more profitability in the sector yet? There's starting to be scale, but you still haven't seen profitability.
I think that's a pretty easy choice. I mean, I don't know all of these public numbers particularly well, but it sure looks to me like if you're running a $300 million revenue business with 30, 40% gross margins, that you can effectively decide to be profitable when and how you want. The question is optimize for growth or optimize for profitability. Rocket Fuel's margins are higher than that, but they live or die on growth. The second that company slows down,
Right.
it's not worth $2 billion anymore.
Right.
So I think these businesses for the past 15 years have been profitable, and at any point they could be profitable, but then they're not growth companies. So I think it's a fundamental trade-off.
Yeah, so clearly we have a chart that is in one of our presentations that really talks about the fact that in today's market, it's really growth and scale is what public investors are looking for, and at the expense of profitability for sure. What do you think about the IPOs that went out there this year in AdTech? Yumi, Tremor,
Well,
Rocket Fuel, Criteo?
I was an investor in a company that Tremor acquired, so as a Tremor shareholder, I'm very disappointed with their results. Again, I think it's really hard for the markets to really understand the core of these businesses. I mean, in a year, will Tremor be successful in the ad network space for video? It's really difficult, I think, to judge, even for me as an industry person. If I look at Tremor, AdaptTV, Yumi, Brightroll, and a handful of others, it is very difficult to really differentiate between these companies from inside the industry. If you look at AdaptTV and why it's worth $400 million to AOL, it's very difficult to understand. And if you look at why Tremor, which is a $130 million top-line revenue company that's not making money, why they're disappointed to be worth $200 million. I mean, I think there's a lot of people out there with relatively slow growth, $200 million unprofitable businesses who would love to be worth $230 million. So I don't know. I mean, that was a surprising IPO price, not a disappointing outcome, I think. And I think that's where a lot of the mismatch is these businesses don't justify the price unless they're spinning straw into gold. And it's amazing how few companies, when you really dig inside them, are spinning straw into gold. I just don't think that happens very often. So I don't know, I think that's where we always have struggled in this space is, we love to tell these stories about internet scale and the hyper growth of some new technology or new angle, but if you actually look at the size of the market, you're talking about a $20 billion market in which the ad network companies tend to make 30% margins, and of that space, Google has somewhere between 30 and 50% share. So you're basically competing with Google in a market in which they have every single asset and every advantage. They can write billion-dollar checks anytime they want to acquire your competitors, and they own the frickin' phone operating system that you're trying to make money on. And what was your strategic advantage again? I mean, it's really, really challenging.
Yeah.
So that's the problem with these IPOs, there's no magic here, and the space is small, relatively speaking, and competition is crazy.
So one more question, then we're going to move into mobile for a second. But, so a guy like BlackRock, I mean, for as you said, Brian, it's hard enough for people that sort of live and eat and breathe this ad tech stuff every day to keep up with it, to figure out whether one guy's worth $400 million and the other guy's worth $4 million. Does that get worse now that you see sort of what I would call sort of guys like BlackRock, more big general guys kind of making bigger bets, or is that just a sign that Turn has really made their clear market leadership position, and so it's okay that a guy that's sort of less knowledgeable about the industry kind of comes in? And the same kind of questions for public investors as well. Are we going to continue to see a lot of volatility because, again, these investors aren't ad tech specialists by any means?
I think that the risk for a BlackRock, I mean, how much money does BlackRock manage? $3 trillion? Anyone know the number? I mean, to write a $20 million check to Turn out of one of their portfolios, I mean, I think, I could be wrong, that a lot of this is about wanting to get an allocation in an IPO process. These companies don't have a lot of float. If they're going to go public in a year and hand out $100 million worth of equity, it's going to be hard for a Fidelity or a BlackRock or some of these really big asset managers to get enough shares to make that worthwhile. I think the risk of taking, I'm sure the valuation wasn't nearly as high as a Rocket Fuel or Criteo valuation, and so the risk of getting effectively pre-IPO shares just doesn't seem that great. I do think, though, that we're going to see some folks get burned, and that when they get burned, we'll see these people run away again. Yeah. Because that was not an impressive round for Turn, based on what they were telling the market that they were trying to raise, yeah, and how they went out and tried to do it. I felt that was a disappointment. I think it's a sign that you're going to have to come out with a much stronger story, much more magic, or a much more fundamental business to get real value. why not go public?
Yeah.
I mean, they have a CFO, they have scale or they don't, and I don't know. In a bubbly environment, my advice to anybody out there would be, ask these really hard questions and be very skeptical of the answers, unless it's me, in which case, believe everything I say and buy a lot.
Okay, all right, mobile. George, like we said, mobile came to the mainstream this year. You had a deal that got done. Talk about what your observations are for 2013 and mobile. First of all, do we deserve the hype that we're giving it in terms of that mobile does go mainstream? This was the year of the sort of turnover in terms of, whether that's the internet titans and their percentage of revenues that come from mobile, whether that's the smartphone mobile crossover. What's your take on 2013?
I think it was a transformative year from the point of view of the acceleration of adoption and distribution of devices, more as a consumer experience and a consumer adoption. I can't think of a thing that people won't do on their mobile phones these days. The monetization, the capacity to actually target audiences, understand what an impression is worth and so forth, continue to be lagging the broader adoption of people's use of these things. So, continue to be another big year for, oh my God, 10 times faster than the internet and so forth. But I think it was a reasonably flat to disappointing year in terms of any real breakthroughs programmatically across how to understand audiences, how to target audiences, and so forth. And the
Do you mean that
oddity
from an
is,
advertising perspective or from a sort of
you name
consumer?
it. You name it.
So you would also
Because
say that's true from a consumer
it-
sort of usage perspective?
So in the app economy, 2013 represented a shift from most app developers thinking they were going to live on a diet of subscription to most thinking they're going to live on a diet of advertising. And when they do that, they recognize, I don't know jack about advertising. And I didn't set things up within my app to know anything or collect data about advertising. And it's not something I do natively and so forth, right? At the same time, in 2013, at least in mobile, you certainly had the rise of the presence of exchanges and the presence of the ability to do what Brian said, which was sort of seamlessly access any piece of inventory from any site or app anywhere. So it's sort of like, great, now we have a marketplace, you have real fluidity, but why would I buy this impression versus that one? And what can the publisher or app developer tell me about that impression? Who are the people that actually use that recipe app, right? And so this guy's packing metadata in that says, moms? And we're going, okay, that's great. What else can you tell us about the users? Well, that's it, and so forth. So this 15 years of digital build-up around trying to use a cookie and other mechanisms to understand audience sort of cleaves and falls away when you get to mobile, and you have people really trying to tread water and say, I can be in the advertising business, I've got lots of impressions, and I've got an app that's all about recipes, and this is where these other themes of data and supplementing your knowledge of an impression and so forth come in, and that's sort of rushed in 2013 as well in mobile. Everybody started to try to embrace and grab data to supplement their understanding of audience. So
Do you think there was some pretty innovative stuff, though, in the e-commerce world and in terms of e-commerce and payments and in mobile in terms of use of location-based data? And I mean, wouldn't you say that sort of that world is much further ahead than the sort of advertising world?
Location-based, yes, but if you look at it, other than things like Black Friday, Valentine's Day, other than sort of event-based marketing, if you walk into a large multinational marketer and someone across the desk is all excited about hyper-local, and you sort of lay out capabilities, and then how many people you can reach at scale on a given day in a Walmart who have a phone on, who have the capability to receive this type of ad, who can get the alert, and so all of a sudden you're down to like, a couple thousand people. And they say, well, how many Walmarts can you do that across? And look, Millennial's got a footprint, Millennial and Jumptap together, a footprint that is as big as anybody in mobile and be able to do that type of thing. And it's always more exciting right now to think about what you could do with those possibilities than actually to land the reality. In fact, in many cases, it's a sales tool to open up a door, and then I'm actually falling back and kind of buying a more traditional program from you. And actually the age of hyper-local targeting for retailers, the prototypical, I'm walking by Starbucks and I get an alert that says I can get a free cup of coffee. Show me a case study anywhere that says someone spent more than $100,000 and was successful with that. It's very squirrely.
So we're still in evangelistic days.
Yeah, and I think there's nothing wrong with that, meaning with a nod to all of the confusion that Brian described online, which also exists in mobile for sure, and probably a little worse, because there's also the intimidation of, this grew so fast, and I'm a media buyer, I'm a marketer at a multinational, and I should know more about it than I feel I do. I should know the abbreviations better. And I swear to God, if you walked into P&G and said, okay, let's have a open day, best possible mobile technology companies, people that do targeting, people that do data, people that find audiences for us, right? And there's 15 presentations in the course of the day, of which they rejected 100 companies and got it down to 15. And then at the end of the day, you redacted everybody's names off the top of their decks and turned them sideways and said which one was which. Most of the people in the room aren't going to be able to tell you. It's not their fault, by the way. You know what I mean? These are not stupid people. My point is, it's happened so fast. And it's intimidating. And so when someone says, so, you know, will I really know how many diapers we sold? You know, that's sort of what they really want to know. But they feel constrained to ask it by, well, so am I going to be buying programmatically with you? Or, yeah, they sort of want to be hip to the language of it all.
But don't you think that that's why it's so impressive that guys like Facebook and Twitter have changed their businesses so much through this year into mobile? I mean, that's hard, right? Talk about stuff that's hard to do, right?
Yep. And they've got scale.
And
they've got enormous scale.
Right? I mean, so you wonder if today we're at this point where we're still in the evangelistic sale mode, maybe the emperor has no clothes type thing, whatever. You know, that's got to change fast, right? Because look at how much those guys have changed their business in, you know, sort of 18 months' time.
Well,
aren't they going to help to lead the way from a mobile perspective?
The one thing that was really revealing to me was people, the big tickets across the larger mobile platforms right now are still generally not going in a competitive way because of media. And what I mean by that is, you know, I come in and say, we could give you $20 worth of media, $20 million worth of media for $10 million bucks. And you get a great CPM, right? And that's sort of a mature negotiation in media about who's going to provide more value and gather more audience and so forth, right? What they're really much more interested to pay for and willing to pay for is a much more educational, hand-holding, product-driven sense of education. So some advertisers have said to us, we sit down and say, okay, we want you to spend $15 million, $20 million with us in 2014. And you would think what happens is you have this media negotiation. No, it's how many people can you get here once a quarter to meet with our product managers to talk about the capabilities in mobile that we should be spinning up, and talking about what our competitors are doing in mobile, and talking about things that we could do that are innovative to put us ahead of others in mobile and so forth, right? So we think of this as, you say, wow, it's impressive that these guys have moved so quickly. That presumes that you're at a sort of mature sense of media and understanding. You're just negotiating price or reach or frequency. And in fact, what's more fundamental is you're negotiating for education. And that's incredibly important for the industry because it will open up more dollars as confidence grows. But at the same time, it really means that you're not negotiating media. So most of the people, the scales fell from my eyes last quarter in negotiating some deals into fourth quarter in 2014, where people were pulling me aside saying, look, I don't care what the CPM is. Okay, what I want to know is I want to do these kinds of programs. I don't have any idea how to do it. My product managers don't know how to do it. I run a spaghetti sauce or I run a deodorant, and I watch all these other things around me happening in mobile, and I don't feel we're doing that stuff. And I don't want to hear about any other companies. If I want hyperlocal, you guys don't offer, go find it. You know, if we want to do some experimentations with programmatic, go find it, right? You're basically being asked to do high-price relationship management. And that, at maturity, will turn into media negotiation, but not yet.
So, Steve, would you say in the e-commerce world, would you agree with sort of George's comments?
I don't know. You know, my view of Rue is, I would say one of our biggest strategic challenges, and probably most .com e-commerce companies would say the same thing. How do you dramatically accelerate, you know, new customer acquisition at a much bigger scale than we are now? And certainly we have a player in our space in Zulily who's accomplished that. I mean, the fact that they're spending, you know, $65 million this year in internet advertising is a really big number for the size of their business, the space, and what you would have otherwise expected. For us, mobile advertising in general is taking a much bigger wallet share than it has before. I think it's more a reflection on us starting to get a little bit sophisticated about it or a little bit smart about it. So I think it's really about our own learning curve. It's very easy to just go to Facebook and Google and for them to be the players that help to accomplish that for us today. It is working. I mean, it's the scale at which we're spending today in our world relative to what it was 6 months ago. It's crazy.
Is there any
From
lessons?
$5,000 a week to $100,000 a week in certain platforms specifically geared in the mobile world. Are there any lessons? For us, it's platforms that can do the job to help us define lookalikes by combining our data with their data, regardless of the forum, whether it's mobile or it's desktop, is the magic that makes it work regardless of the platform.
And
it so happens 40% of our business is mobile, so it's easy for us to get an app download on a mobile site and actually leverage that and monetize that in a way that's maybe different for most e-commerce companies. But it's all about the audience for us and whether you can really target the right audience to generate a decent amount of revenue for the publisher and the right ROI for us.
So, and do you see any difference in terms of the kind of either the type of consumer behavior on mobile versus desktop and/or the type of consumers in your business, that are more mobile-centric, i.e. younger or whatever?
Yeah, so mobile consumers are younger. Putting aside demographics, mobile users are far more valuable to us, period. A mobile-acquired user is much more valuable than a desktop-acquired user. There's a host of reasons for that, including our business of sending emails out. I get an app download, and I not only can communicate via email, but communicate via mobile alerts, which is an incredibly powerful platform for our business. And then we have a bunch of views. We have one-screen customers, two-screen customers, and three-screen customers. It's kind of our multi-channel. It's multi-screen. And as you'd expect, a three-screen customer is like 400% more valuable than a one-screen customer, even if that one screen is mobile, whether it's desktop or what have you. So the key is get them to love your brand, have them engage with you on all channels, and if I could choose where to acquire them, it would always be mobile first.
That's interesting. So, Brian, on this question of mobile and ad tech world, what do you think the percentage of revenues coming from mobile is today in sort of the average ad tech world? And do you think that, as you said, I think earlier a little bit, do you think people are going to wake up and say, oops, I'm not as far along on my own mobile strategy as I should be? Or how do you see that sort of playing out? Would you echo sort of George's comments in that regard?
Well, I try to echo George in everything. But I'd make a couple of
It's good
points.
strategy.
I know. So one is that mobile's real. I mean, I think it's clear that, does anyone here not have a smartphone? My mom got a smartphone on yesterday, and she was so excited about herself. And I was like, welcome to 2007, Mom. Gosh, But, that's sort of scary. Like, everyone is on their phones now. So this is real. Consumer behavior is not going back. No one is giving up their phone for a PC that I know, or their tablet for a big hunky desktop. Two is that the reason Facebook and Twitter and Google have done so well in mobile, I believe, is because they didn't sell it as mobile. They just made all of the existing ads work. You buy clicks, or you buy likes, or you buy whatever the heck you buy on Twitter, friends, followers. I bought like 5,000 followers in Brazil, and they don't speak English. But anyway, they were extremely cheap. Yeah. They all want to friend me on Facebook now. So actually a cheap back end to get Facebook friends. Media. Exactly. Right. That's it. Earned. Oh, yeah, you're right. So the point is that they sold it as if it were display. And so the third point is that display on the phone versus display on the PC isn't going to really make a lot of difference pretty soon. Because tablets, I have a new Microsoft Surface. I'm not sure what it is, if it's a PC or a tablet, and it's not sure either. So I think that's the point, is that the reason those companies have been successful is they sold it all as just whatever they were selling anyway. And so I look at Appnexus and think, we have to support across all screens. So it doesn't really matter what kind of screen it's going to be. We need a solution for you. And if you look at it from the perspective of a millennial or a Jumptap, the temptation to start selling cross-screen or to sell into display, I mean, if you're already providing sophisticated consulting and running these programs, why does P&G care if it's on mobile and tablets, phones and tablets, and not surfaces? And why is the next screen so difficult? And if you've got all the sophistication, the hyperlocal data, people are walking around with their laptops. Anyone here bring their laptop to this conference? Guess what? You're local too. So I think those are the three big things I would say is that, for me, I am trying really hard not to distinguish. Appnexus has started to roll out product mobile first, which is new for us. So we actually support video as a format only on our mobile SDKs. So we're starting a video business to compete with potentially people like Adapt TV only on the mobile phone. You cannot sell desktop video through the Appnexus platform, but you can sell mobile video. And it's the same with rich media. So if you look at our business, we're just saying, why even go build stuff we skipped the first time around? Let's just build it for mobile and wait till everyone shifts. I walked in today watching Jon Stewart on my iPhone as I was in the cab, and that's really pretty powerful. I think most major media companies are seeing mobile video growth go crazy, and that's where there's really opportunities. So I guess to sum up, that's where you have to be, and the winners and losers in that space will be completely random in some ways. There'll be mobile-first companies like Millennial who in a year are just really powerful programmatic media companies. And there'll be display companies who miss mobile. I think it's going to be really almost random to see who gets traction and whose strategies actually work as we cross that chasm. And the one mystery is going to be data. Can we combine data across devices or not? We're 18 years into the display online advertising world, and we've never combined data across browser or cross device. So I have a PC at home and a PC at work. That was never a problem. But we're all obsessing over why can't I get my PC data to my phone? And I think the privacy implications of that and the technology implications of that are very interesting coming from my world where we never tried that particular thing.
So let's be really clear about what Brian just said. So if you're looking at a BMW on your PC at work, you take the train home to Greenwich and you're looking at some things on your iPad, BMW, and you get home, put the kid to bed, you look at it again on the iPhone, and you're thinking, is the dealership close by? To an advertiser or an ad tech company, those are three different events. And what Brian is saying is it's crazy that they're unlinked, right? Everybody wants them linked. In fact, the advertiser wants them linked, BMW wants them linked, and in some ways, the consumer wants them linked. Because if I'm moving toward, this is going to be my first purchase and test drive at a BMW dealership, it's give me the incentive. Or am I a 6-time BMW guy and I buy these things every 2 years in my sleep? That would be good to know. And so that's a margin problem for BMW if they don't know that and so forth, right? So in a way, all the constituents to this particular little transaction want the same capacity for transparency and knowledge, and it's not there. Okay, we spent a year at Jumptap, half the time with Brian, half with, just sort of trying to figure out how we're going to do this, because when you do walk into these characters and they say, other than the people that are natively building their business in mobile, advertising, marketing, download in mobile, like all the games guys, whether it's Candy Crush or Angry Birds, whatever, if you live in a world which is both digital and physical and have goods that you're transacting with people, you need linkage. And one of the things we saw is massive fragmentation of screen and, in fact, complete consumer indifference. Where if I said to you, what was the score of the football game last night? Great. What screen did you get it from? At this point, everybody's like, what's the point of that question? Not only do I not remember, why is it even relevant, right? And so we're all in a multi-screen world right now, and linkage is important. So I'm investigating a movie for next Friday night with my wife on my iPhone, but end up booking a restaurant on my iPad. And those are unlinked, right? And so forth. So this is a real opportunity/problem.
So do you think we're going to see, so that segues into the kind of next topic of what's going to happen in 2014 vis-a-vis data and privacy and linkage? What are we going to be any different if you're standing here a year from now than we are today?
I think it's we all want these things to be less messy, and we want clarity to arrive faster, and it's not going to. I think this year will be a lot like last year. Certain trends will accelerate, everyone will rush to mobile, people will try to understand data. We have 30 or 40 different data partners that supplement the Jumptap millennial understanding of what audience looks like, but we're not sure we apply that data correctly all the time to the best interests of either discovery of audience or advertiser. Devices themselves become matters of data targeting. If you're on your iPad all the time, maybe we should get larger format advertising in front of you. And we know that full screen advertising and video works a lot better in terms of conversion, impression, and so forth. So the device itself starts to become a targeting mechanism that itself is a stream of data that needs to be understood. So I think what 14 will be is sort of more important steps forward in all these areas. I think consolidation will quicken because you have a lot of these $5, $10, $15 million private Series A, B, C companies that aren't going to be standalone long-term companies. There are too many of them. I think scale will continue to be, separating the big from the not so big. Larger advertisers do want to spend significant amounts of money and learn at the same time. So a $20 million annual deal for someone sounds like, wow, sounds like a lot of money for a little company. It's not. It's not a lot of money out of their budget. And so that's the way they think about it. And of course, we haven't uttered the word television on the panel yet. And you have all these smart TVs coming to market now, and Samsung's done a nice job with these things. These are basically, as far as I can tell, these are app stores, ultimately. And that's another data set, another screen, another interaction to understand, everybody knows the old solve, highest velocity of activity in the NFL app is during NFL games. Well, that was surprising to the NFL. Okay, well, what do you do with it? And so forth. So I think one of the things that will be really interesting is sort of watching how TV edges into this multi-screen, data-driven. I think of the app store as the metaphor of it in some ways. And I think that's sort of a biggie. Won't be binary because it won't be an all or nothing, but it'll certainly start to creep into the language of all the things we do and the conversations with advertisers, I'm sure, in 2014, and probably start to get some traction in 15 and beyond.
One of the challenges that I think has to be solved is, you showed a graph, I think it was 50% of the traffic of many of these e-commerce titans, but if all the my e-commerce peers would show 50% of the traffic as well, and most of them will show 10% of their sales from mobile.
Right.
Yeah.
And I think, finding solutions to help to bridge that gap, as people invest in e-commerce platforms or find other ways to make sure that they can convert traffic on mobile on their own site or their own, credit card application process or whatever it might be. As that happens, it's going to be, there's not going to be an experimental wave, at least in the sort of direct marketing world, not an experimental wave of money that moves over, but a giant pool of money that moves over. Really, 50% of advertising dollars should be going to mobile because 50% of commerce is on mobile because 50% of traffic's on mobile. But there's a real disconnect to that right now, and it's a real opportunity.
So our one-liner on that is that, if you think about sort of where digital marketing and ad tech was 3 years ago, that's where we think e-commerce is today. Like if you think about e-commerce as a percentage of total retail sales, it's just under 10% today. If you take that one step further and you say, well, where should mobile then be sort of in that chain? It feels like it's the same kind of theory, which is it's going to happen, right? It's just waiting to happen. We have a couple of minutes here for any questions from the audience, and otherwise I'll ask one last one. These guys, anybody? Go ahead.
Yeah, I don't. I spent some time in Brazil as well, where mobile penetration is just through the roof also. I can't speak to the advertising context of those. I can say that at least from sort of Brazil and certainly my time in Spain, that while usage was really high, commerce and transaction was not. And so even in a place like Brazil, where mobile penetration far exceeds the US, their networks are far inferior. So they're on 3G, not so much LTE. The quality of the phones that people are carrying around is not, you wouldn't have the same smartphone dynamic as you're walking around the streets here. And the percentage of sales that's occurring, at least in the commerce world, is much smaller than it is here. So I think, commerce or behavior hasn't caught up with adoption, at least in the areas that I've had experience in.
So on the media side, for us, Tokyo, Singapore, Kuala Lumpur, big. Emerging and getting bigger in Western Europe, although smaller markets, principally UK, Germany, followed sort of neck and neck by Spain and France, and then certainly some explosion in South America. China lagging, Usage of the phones, generally speaking, across all the markets I just described are still more text and voice heavy. The app stores themselves aren't as rich, therefore there isn't as much velocity in advertising. People trying to get a user, acquire a user, and so forth. Access to content is more limited, therefore also the publishers in those regions are a little bit further behind in their own media strategies for mobile, therefore their marketing budgets are smaller, and so forth. So you have sort of usage limitations or characteristics in those markets that are dampening the growth of advertising there, but in the sort of most sophisticated way, one of the great things happening is our ability to access inventory in those markets programmatically and be able to service a customer from a bevy of machines in the United States, or sort of be able to host ads that are driven from our own platform through servers that are distant but under our control, and not have to build the same infrastructure all over again in these places. So they're actually jumping onto exchanges a little fast, like especially out of Singapore, Tokyo, and so forth. They're moving inventory onto exchanges faster, although it's not as much inventory, it's not as valuable, and again, it's more driven by sort of text-based interactions that don't lend themselves very well to advertising.
Okay, last question. What stock are you going to buy for 2014? George.
I'll let you start.
Millennial Media? I don't buy stocks. What would I buy? Well, I suppose if you looked at it, I'd still say Apple's a very good price, and if they get TV right. If you look at the amount of cash per share they're sitting on, it's crazy. So I wouldn't be surprised to see Apple run another $200 or $300.
Okay, Brian?
I also don't buy stocks. But I like Millennial, actually.
What a suck
I
up.
might have a conflict, though.
I know I do.
Steve?
Despite some of the audience concerns with Facebook, and as I hear some of the complexities, even in this discussion, that I wasn't as privy to, I mean, my ability, I can buy an audience across any device via Facebook. I have a lookalike strategy. I'm targeting them on their iPhone, their iPad, and the web browser. The tools that Facebook is providing us are just change our world as it relates to what we're capable of doing from an acquisition perspective. So I think there's going to be, I think Facebook's going to continue to see huge acceleration in advertising dollars and share, and that would be a reason to buy. And then if all the teenagers and keep leaving Facebook, that'll be a reason to sell. So I don't know what you do with that, but I think the profits and cash flow are going to be a lot more, and they're going to probably they're going to have a couple $1 billion plus acquisitions this year, would be my guess, to help
There's
your
a
account.
little company called We Heart It that, if you guys haven't heard of it, we were talking about it last night, is presenting probably one of the more unknown companies in our roster today. So we'll see whether they take the tweeners out. Thank you very much to all three of you. Great start to the day. Appreciate your insights, and off we go. Thanks.